Thanks, everyone. Well, hopefully it's interesting. Look, when we looked at it this year, we were talking about 144A or euro, and obviously as a US house, people was often thinking about 144A, but we actually in the last 12 months have found ourselves doing more euro issuance than 144A. And when you look at it, actually we've had a lot more Australian corporates accessing the euro market than 144A. So I just thought it was interesting to think about some of the themes around that this year when you're looking at it. So when we look at the 144A market, just touching on the sizes of the market, going to the other side of Bill's question, if we'd had this one first, you would have all known the answer straight away, because there's the US market just shy on the corporate bond side of 1 billion. The euro markets last year, 485, sterling 65, China and out of Asia. Really, and then we've said, Aussie dollars 107, but that's actually including all the SSA and, all the other issuance that we see out of in Aussie dollars. And as Bill mentioned before, the Australian corporate bond market is, around 10 billion. Just down below, excluding US private placements, is what did Australian corporates do. So this is what the Australian corporates have done in the public markets. Circa around, normally it's been around, 10 to 12 deals. We saw some real pickup in 2012's cross-border, and that's because, when you've got BHP issuing $5 billion in one chunk, that obviously, and then I think Rio last year doing $3 billion in one chunk, so that $19 billion includes $8 billion by two issuers. And I think, ultimately, that's this is the big end of town for people who have lots of, large borrowing requirements. From that perspective, you just flicking on when we look at FIG versus corporate as well, because the banks are obviously out of Australia. That all the four Aussie majors issue a lot, but we're seeing around somewhere around 60% of this issuance is actually from corporates from that side of things. But obviously the banks are a very large part of it, and the numbers when I'm saying out of Australia. Going back here, this is just the corporates. It's not obviously including the financing requirements of the Aussie banks when they issue cross-border as well. One thing just looking through 2012 into 2013, most probably the main theme is just an increase in triple B issuance, in terms of the participation in 2013. It's not that it wasn't there in 2012. I just think with the attractive spread environment in 2013, we just saw more lower-rated corporates accessing the market, and investors really searching for yield. But the 144A market or the US markets, which includes SEC registered, the main thing on this market, it's the long end of town as well. So when we look at it in the US perspective on it, and it's thinking about 10 years or longer, that's basically 60% of the market each year. Is people issuing it in 10 years or in 30 years. And actually in Europe and out of the US this year, we've also seen some 100-year bonds, but none of us will be around to refinance those. I don't think I want to be around to refinance a 30-year bond either. But I have refinanced a few 10-year bonds over my time from that perspective. But that's most probably, 144A, this is the real long-end part of town. As Bill's touched on, the USPP market, though, that's an excellent part of the curve for 12s and 15s. In the 144A market, you really don't see 12 and 15-year money. It's 5s, 10s, and 30s. It's really where we'll see it on touching that. So not... very kind of much more prescriptive than what Bill's kind of highlighted to you on the private side. Diverse range of industries, though, going. So this is where you'll see it, we've lumped in there industrials, that's kind of everybody else, really, to be honest. The only interesting, most probably, is the big tick up in TMT from 17% to 24%. But when you, do a $50 billion deal for Verizon, it will start swinging the numbers, and also some of the tech companies accessing the market. Euro and sterling, just quick looking at that. So again, pretty consistent across single A and triple B from a corporate perspective. This part of the market is actually most probably more suited for corporates between 5 and 10 years for euros, and then for sterling investors, it's much more 10 years to the plus. So we do see a little bit of short-dated sterling, but the predominant issuance really attraction is 10 years to the plus. And I most probably should have cut these graphs a little bit long, slightly differently, because I've kind of said 50% of the market last year was 5 to 9 years. Obviously there's a bunch of that bit in the next column where it says 10 to 29 year. there's most probably at least half of that's really 10-year money. So it really is, we're looking at around 60% of the market here is much more in that 5 to 10-year part of the curve from that side of things. Again, pretty diverse from a industry's perspective. So what were some of the themes? Well, as I've said, it's the big end of town, art of the possible. Last year when it came, I don't think anybody would have asked us the year before on hey, if we did a large acquisition, could we refinance it with a $49 billion bond? Now we know the answer is yes. With the Verizon trade, and Apple was up there too with a $17 billion and Petrobras with a $11 billion. So this is the dollar market. It's the big, deep, large end of town. It's not really what, if you're going there for your 500 million, it's not what is, this is the other side, but this is the large side of the things. The other interesting thing that really came through last year, and this is what is relevant for Aussie corporates. Australian corporates have often gone, should we go to the US, should we go to Euro? And historically, I've done this for a long time, 9 times out of 10, dollars has always been pricing better. Last year, we really started seeing Euro price better, and we'll talk a little bit about the trends, but we weren't the only ones who noticed it. We also saw a lot of the US corporates suddenly going to Europe a lot more for the first time. So, AT&T had done that, but Microsoft, 3M, and there were a bunch of others. And really, there's the reversion where the basis swap between euros and dollars made it much more attractive. So if you are borrowing in euros, you actually swap back through US dollars to get to Aussie. And when you do that and you're comparing it, so when the basis movement, people often always watch the US dollar, Aussie basis, you actually also need to watch the Euro US dollar basis. And that's what made it very attractive last year. The combination of credit spreads kind of coming in euros, and then in Europe, the change in the basis between euros and US dollars, it made it very attractive. So it wasn't just the Australian corporates that were looking at this, but it was also the US corporates, and that's a theme we've continued to see in this year. Just a few other themes that we are seeing offshore is, coming, and this is most probably more global themes, usage of, in the US, we're certainly watching, what investors worried about a little bit more, how corporate, how shareholder-friendly our clients are starting to become. So we think through from the financial crisis, 2009, 2010, everybody was super conservative, refinancing their debt, terming things out. What we're starting to see, more globally, and themes coming back from investors is a focus on, shareholder activism. If you think about it just through the latest reporting season, look at the number of Australian corporates that increase their dividends. So they're looking at those types of things. Nothing to worry about, but just things that investors are focusing on. And then just touching on Australian issuance, as we said, a lot of it, a lot of the guys going offshore, but most probably the more interesting trend was moving into, Australian issuers into Europe, which is highlighted on the next page. So this is kind of public bond end of town, who's issued in the last 2 years, in 2012 and 2013. If you look at 2013 in dollars, take out the large Rio and BHP deals, there were only $4 deals in the 144A market last year from Australia. And one was Wesfarmers deal, for $750, and then Origin's transaction, and Origin also did in Europe. But when you look at on the right-hand side of the Australian corporates, we did 10 deals, by Australian corporates into the Euro markets last year. And I cannot remember the last time it was like that. So, much more, shifted into, going into Europe. Now, some of it is by, everyone knows Telstra's gone to the Euro markets for a long time and have used that. And we know Amcor have Euro borrowings, so that's why they look at that. But the bulk of these issuers who were looking, they were looking at dollars, looking at euros, and then when credit spreads, through last year continued to tighten in Europe, and combined with what was happening on the basis, Euro funding became much more attractive. And I would say on average, for names, we're talking anywhere between 20 to 50 basis points better to fund in euros right now, depending on the name, than what we're seeing in dollars. So it's significant, and I think this market's here to stay. At the moment. So I think people will be looking a lot harder at euros, because at the end of the day, I'll talk a little bit about the features that go into both markets. But no matter what the documentation cost is or the work, you'll always go where it's cheaper at the end of the day. And when it's this much of a difference between the markets, you will look at euros over dollars. If you're looking for size, As Brad knows, I think the Aussie market right now, to be honest, is for a lot of names showing pricing well inside both of these markets as well, but you're not going to come and raise, BHP's not going to come and do its $5 billion deal here. So, but I think, it's not trying to get away from the Aussie side, but when we're looking at cross-border, if you're looking for some diversity, increased tenor and volume, you're looking at these markets. Going down. I've talked a bit about spreads and basis, so kind of not going to go into that too much, but just what really happened through last year. So if you remember around May or June, spreads have kind of been coming in through the year. Then there was all this noise about Fed tapering, and all spreads around June widened out a little bit. US widened out, so did Europe. And then Europe went, well, Fed tapering is really nothing to do with us. That's all about what's going on in the US. And then what we really saw through the summer period, there wasn't much issuance. The spreads really tightened a lot, over that summer period. So that's actually when you go back, you suddenly had issuers, we had this flurry of issuance, in the last quarter last year. Westfield Retail Trust, pricing was better in euros. ASEAN did sterling, Melbourne Airports, Simon will touch on it later, but Melbourne Airports have been looking at dollars and euros. Suddenly the euro market became much more attractive. Origin, same thing, obviously had refinancing to do, and Transurban was the same thing, looking at dollars and euros. Euros suddenly became a lot more attractive, and people felt a lot more comfortable with execution in those markets. So 2014, where do we think? We think that theme's going to kind of continue. We think spreads will continue to grind in. We've certainly had a few, noise around emerging markets this year. Obviously there's noise out of the Ukraine. So the markets are going to be volatile a little bit and things like that, but we need to just, navigate that. But, that's, when we look at the straight technicals in the market, there's a lot of cash still in the market. You've heard the same theme from Bill on the US private placement side, the same in the public markets. There's just not that much supply. There's not much issuance. We're not seeing any rotation out of bonds into equities or any themes like that. So it's certainly, very, very strong bid in the market. We think spreads in US will tighten in, but as long as there's noise and volatility around the rate side and what's happening with treasuries, spreads haven't improved in the same way as they have in Europe. So the gap's narrowed from where we were last year. So it's always something to watch because it can change back. But at the moment, we still think euros is most probably and generally more attractive. And as really coming back to the last point, the reverse Yankee, as we call it, it's not just the Aussie names, it's all the US guys looking in Europe. We do think that theme is going to continue into this year, and we've seen several US corporates actually borrowing in euros and tendering for the US dollar bonds at the moment because it's just so much cheaper. So quickly, just then, well, when should I go and why should I go to this market? It is the bigger end of town, as I've said. So, benchmark size in euros is around 500 million, or sterling 200, a 144A around 500 million. But you can do sub-benchmark deals in both of these markets. So just don't always just cross it off and go, I've only got 300 million to do or something, you should always still look at this. You can do sub-benchmark deals in strong markets, and we've seen several Australian corporates do that. Amcor's done that, SPL's done that, so definitely think about that. So 300 million in euros, 150 in sterling. We tend to find below 150. Investors do kind of struggle with it around the 100 million sterling mark, but, 150 in sterling. The same on a 144A. We actually do for example, a lot of the property names actually access that market in the 250, 300 million, so don't always assume it should be 500 million. Tenors, euros, 5, 7s and 10s, but this is where euro is very attractive. You can do an 8-year deal. It's not as regimented as the US. You can issue in 8 years, 8.5 years, 9, 6. It's a slightly different market, gives you a little bit more flexibility. And we do see, a lot of people look at the euro market for that 7, 8 year part of the curve, as well as the 10-year part of the curve. As we've said in the US, 144A, it's 5s, 10s or 30s. We've seen a bit of 7-year issuance this year, but I cannot remember when the last time I really, it's been a good few years before we've done a 12-year bond in the 144A space. But we do them all the time in the private market. Ratings, obviously you only need one rating in Europe. You need 2 for a 144A typically. from that side of things. The other bit is most probably documentation. The documentation process on a 1-foot freight, the first time you do it is a little bit more intensive. Simon's laughing at me here. A bit more intensive. But, you know, when we look at it on the Euro side, that is actually, it's in Europe, it's cheaper, it's easier. Dealing with the auditors is relatively easier. The requirements on the Euro side is a lot cheaper and a lot less cost, you know, a lot less onerous in terms of what you need to, from a disclosure point of view. You do need to have a listing in Europe for a European bond. The listing can typically for Australian corporates is done on the Singapore Stock Exchange, but we have seen some issuers also list on the Australian Stock Exchange, and that's because there are one or two investors that prefer to have an OECD listing, and Singapore's obviously not. When you do go to the roadshow, nice places to visit. You know, in Europe, you know, it's pretty pleasant. You go to London, Paris, Frankfurt. Sometimes you might go to Munich. Sometimes you might also wrap in Switzerland and some of the other locations. In the US, typically, if we are going to roadshow, it'll be New York, Boston, and we most probably will do conference calls for the other centres. Occasionally, we might go to Chicago and Philadelphia or the West Coast from that side of things. One just nuance of execution in Europe is just deals get done differently. In Europe, you will always announce that you have mandated XYZ banks to do a roadshow, and a deal may or may not follow. And that is the standard practice in Europe over how you do a deal. You can then go and roadshow, but if you don't like the feedback, don't want to do the deal, there's no need to go and announce your transaction. It's quite normal practice just to go to the market and do it like that. So we always call that awareness, an awareness mandate. Just, you know, tells investors you're out there. And the reason for that is very much driven to make sure you're not kind of just marketing to a discrete lot of investors. You know, so there's been some concerns in the past in Europe, you know, you giving preference to some investors over others. So there's, you know, it's very much the mandated way that all the deals get done. If you don't put it out on the screen to say you're looking at road showing, at least, it's actually quite hard to get attention, you know, in your meetings. US is completely different. It's all under the radar. So when we do a roadshow, we often do it. We'll often call it a non-deal roadshow, but we will actually go out and set investors. There is nothing actually on the screen until you're actually announcing you're doing the deal, unless you're in the high yield space, which is slightly different. But generally speaking, on the 144 high grade side, we will just set up the meetings, but there's nothing on the screen. So just one awareness to be between the two different markets. When you're selling your bonds into Europe, it'll be pretty diverse, but a typical distribution on the left-hand side would be 30% UK, 30% France, 25% Germany. There's the largest pools. It will vary a little bit from deal to deal from that side of things. And then you'll see, you know, asset managers make about 70% of the market. On a 144A, it's typically somewhere between, you know, 80 to 90% sold in the US. I've just put 88 here for that. And then 15% or 10 to 20% other. What's other? It's basically Asia. Asia, bit out of Australia, a little bit out of Europe, but pretty much Asian investors buying into dollar bonds. They like the liquidity, they like the size. Nearly, I'd say, well, any Australian corporate we've taken the 144A market, we've always done 2 days in Asia on the way. I think it's great marketing for an Australian corporate to do. They get out and see all the Asian investors who might buy their dollar bonds, but they also see them if they might buy their Aussie dollar, their bonds in Aussie as well. So it's something the only painful side of it is the very long road shows, you know. But, you know, 2 days in Asia before you head off to 3 days or 4 days in the US, it makes that a pretty long trip. But it's something, I don't think there's a deal that we've done that hasn't gone via Asia for a roadshow. And then you kind of see, again, a lot of asset managers buying the market, and the insurance market only around about, 27%, 30%. It will vary deal to deal. This is just one of the case studies I pulled. But it's fairly representative, and the insurance companies are obviously the investors that Bill was talking about on the US private placement side before, where a lot of those guys will also buy. And then Euros versus 144A, the whole kind of bringing back to the theme. So right now, as I've said, pricing is currently much more attractive at present. Australians are basically viewed as a safe haven. You know, during the financial crisis, if you were rotating an Australian name over there, you had the French guys only wanted to support the French accounts, the Germans, and everybody was supporting their home kind of issuers. Now, with you think about what's going on economically there, you know, European investors like Australian issuers a lot. And much more comfortable about them coming back to the market. It's much easier in documentation in terms of setting things up. You have the flexibility to set up an EMTM program, so you can issue there. Then you can issue in multiple currencies under that program. You know, the Telstra program actually allows them to issue in euros, but it's also the same documentation they use for their Aussie dollar program. You can actually look at combining them if you want. So it's always something to think about. If you're only just going to borrow in Aussie dollars, stick to setting up an Aussie MTM program. It's cheaper and quicker and easier. But if you've got a large enough borrowing need, you can actually put it all under one umbrella program on it for an EMTN. You can then also issue in Swiss, which we haven't talked about, in other currencies, or do private placements up into Asia. The one thing with private placements, people often ask me this, well, who would do a private placement under an EMTM program? It does suit best those issuers that already, you know, have a following in the name, like a Telstra or an Origin or any of those like that. But it also suits people who, there might be another issuer there. So I'll pick on airports, saying that Simon's in the room. But since Melbourne Airport have issued in the Euro markets, you know, we get reverse inquiry for the other airports because people now understand the sector and understand, you know, that, you know, as an asset class. So you also might see inquiry from, you know, investors because someone else has issued in that part, in the market. So that's one thing. But if you are a, you know, bespoke widgets company and no other widget companies have issued, well, then it's going to be pretty hard for you to do a private placement straight off the bat. You're just not going to get the same level of interest. Lower cost we've talked about. 144A, well, we've seen it through the cycle. I've been doing this for too many years, and 144A is still the deepest market. It's been the most consistent through the cycle. It is the deal to do those big bang deals, 5 billion, you know, to the plus. But it's also very well suited for anybody looking for the 500 million to the plus deals. Longer tenors, have said, and documentation, once you've done it the first time, it's actually pretty straightforward. But can't get away from the cost of documentation at the end of the day.